Hello and welcome to India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this budget eve. The budget session of Parliament kicks off and the Finance Minister tables the economic survey, projects GDP growth for the fiscal between 6.5% to 7%, says real GDP is now near pre-pandemic levels, expects inflation to remain largely under control, says it could be worth exploring if the inflation targeting framework excludes food inflation. The economic survey calls on the private sector to take the baton on capital expenditure, highlights that private capex has grown by just 80 basis points between FY19 and FY23. Bats for FDI from China, saying it could help increase India's participation in the global supply chain. The economic survey adds its voice of caution to the warnings from RBI and SEBI on the recent rise in derivative trading volumes, calls for careful consideration on the rise in F&O participation, but stops short of suggesting specific measures. The union budget is likely to be a continuation of the February vote on accounts. Sources say the government is likely to opt for fiscal prudence along with some welfare measures. Expenditure, tax revenue, borrowings, interest payments and government capex targets unlikely to see big changes. As Parliament reconvenes, the government faces the heat from opposition on the NEET controversy. The Supreme Court observes there is evidence to suggest widespread leaks, forms a committee to review one ambiguous question, pulls up the National Testing Agency for distributing wrong question papers to some students. A flurry of Democrats, including the Clintons and top donors, endorsed Kamala Harris after US President Joe Biden decides to drop out of the race. The Harris campaign manages to raise $50 million in just 24 hours. Which made it mandatory for eateries along the Kanwar procession route to display names of the owners. Notes that the state police tried to usurp powers it didn't have by issuing directives, clarifies that eateries should disclose the kind of food being served. Well, the big story this evening, it is the eve of the union budget. Finance Minister Nirmala Sitharaman, along with a team of officials in North Block, sat down for the final photo op. CNBC-TV18 learns the budget is likely to be a continuation of the February vote on account. Now, the government is set to opt for fiscal prudence along with some welfare measures. So, expenditure, tax revenue, borrowings, interest payments and government capex targets are unlikely to see big changes. The Finance Minister also tabled the economic survey in Parliament today. Now, the survey projects GDP growth for FY25 between 6.5% to 7%, with risks evenly balanced. The survey also noted that the real GDP is now near pre-pandemic levels. On inflation, the survey is largely sanguine. While the headline inflation rate is under control, there are concerns over specific food items. The survey has called on the private sector to take the baton on capital expenditure. It highlighted that private capex has grown by just 80 basis points from FY19 to FY23. The survey also making a pitch for allowing FDI from China, saying it can help increase India's participation in the global supply chain. Now, after warnings from the RBI and SEBI, the economic survey has also red flagged the rise in derivative trading volumes on Dalal Street. Remember, last week, both the securities market and the banking regulator had raised concerns over the rise in investments into speculative activities. Today, the chief economic advisor has called for careful consideration on the rise in F&O participation, but stopped short of suggesting specific measures. Take a look.
Capital market participation by retail investors is a very healthy and a very welcome thing. The issue is in what kind of capital market participation that they are engaging in. Speculative trading in futures and options is something that I have commented upon earlier, and that's exactly the point that we are driving at, because they are not exactly benefiting either the households or the purpose of capital formation in the overall economy.
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds.
It has now reached a scale where we believe that the micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity?
So all eyes now on the budget in light of the commentary coming in from the regulators and the CA. A special conversation with CA Anant Nageshwaran coming up for you in just a bit. Now, the surge in speculation trading has regulators worried, as you just saw there. But do market participants share that concern? My colleague Prashant Nair spoke with top industry players to get their views on the matter. He joins us now. Prashant, how are market participants reacting to the commentary, the concern that's being raised by the regulators and now the CA as well?
Well, that's absolutely right. Lots of debate, lots of discussion on what should be done, whether something should be done or it should be left alone. And everyone seems to have a view. But we actually reached out to some of the top market participants to understand where they are at on this particular subject. So I'm going to just quickly put out these views. Nilesh Shah of Kotak Asset Management Company told us, and I quote, "I think the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. From a macro point of view, there's the issue of savers becoming speculators rather than investors, resulting into misallocation of savings and low capital formation. From a micro point of view," it adds, "there is the need to create a level playing field between local and global participants in the F&O segment." Sarup Mohanty of Mirae Asset Management also weighed in. He said the number of people who've started this return chasing is scary. While the market cap and the number of available stock and free float seems to have widened, what does not change is the liquidity status of the market. Everything is okay, he said, until inflows are higher than outflows. The day that changes, it can go totally in a very wrong direction. Radhika Gupta of Edelweiss Mutual Fund also weighed in. Regulators have rightly pointed out that most such people don't make money and the potential for losing disproportionate money is high. I do hope the issue is addressed through regulatory interventions. Ravi Dharamshi is a prominent investor, runs ValueQuest. He said, "We can expect measures such as an increase in STT on non-delivery trades, stricter regulations on derivative trading, enhanced investor protection programs, and improved market monitoring and surveillance." Deepak Shenoy of Capital Mine says that option premium is about 60,000 crore rupees per day. All of it goes into bank accounts. According to him, the speculation in F&O doesn't cause a banking problem. It's a social issue, but it's not about liquidity. Rajesh Baheti of Cross Seas Capital recommends changing of lot size or increasing lot size to between 20 and 25 lakh rupees, which according to him would be the most effective step to control retail participation in F&O. He says rather than changing a multitude of variables at once and damage the market more than intended, SEBI should change the lot size variable, wait for new data, and then assess if further steps are warranted at all. As I said, lots of views coming in and markets really anticipating some measures from the market regulator in the days ahead. Back to you.
All right, Prashant, many thanks for joining us, and we will have to wait to see if the budget does move forward and bring in restrictions, curbs, or any measures to check the kind of surge that the regulators are concerned about on F&O trading. On to the market action of the day. The Lal Street trading with caution ahead of the union budget. The Nifty and the Sensex ended a choppy session with marginal losses, while the Nifty Bank ended flat. Mid-caps did buck the trend today, ending over 1% higher. So that's a flat close there coming in for both the Nifty and the Sensex. India Inc. believes the growth projection in the economic survey is cautious. CII President Sanjeev Puri told me that India has the potential for 8% GDP growth. FICCI President Anish Shah expects jobs to be the focus of the budget tomorrow. Take a look.
I would say it's a cautious estimate, and it's, I think, prudent to be a little cautious because that does impact the projections on revenues, etc. What we are seeing is a significant improvement in particularly in the agriculture sector, which was over 1% last year. We expect that to be closer to 4% because the monsoons are expected to be better. Second, we do expect services to actually go up by over 1%, the growth rate. Really what we are saying is that based on these factors, the potential is definitely there for 8%.
We see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher, and that's something that is fairly significant. What we would ideally like is a greater investment in infrastructure, a greater investment in capex formation that will be positive for the economy in the long term.
And you can catch the conversation with CII President Sanjeev Puri and FICCI President Anish Shah at 10 p.m. right here on CNBC-TV18. Their reading of the economic survey ahead of the presentation of the budget. Now, the Chandrababu Naidu-led Andhra Pradesh government has sought a special package worth 1 lakh crore rupees from the centre. The state government has also sought 50,000 crore rupees for the construction and development of Amravati and 12,000 crore rupees for the Polavaram project. The state's industry has also sought special emphasis for pharma, infrastructure and steel sectors. Now, remember, the TDP, which registered a thumping victory in the assembly elections to storm back to power, is the BJP's largest ally at the centre. Take a look.
The special package what the state is looking as perceived for the state is that for Polavaram project and construction of Amravati and so many central universities to come into the picture. The industry naturally will get benefited if all these special packages come, and there will be a lot of economic activity coming through these packages.
Well, that's Andhra Pradesh and its wish list from Finance Minister Nirmala Sitharaman. The Finance Ministry, by the way, today responding to a question by JDU's Rampreet Mandal asking whether the government proposes to provide special status to Bihar. Remember, the Bihar government during an all-party meeting on Sunday reiterated its decade-old demand for a special status. In a written response, MOS Finance Pankaj Chaudhary laid out the contours on the basis of which special status was granted to some states in the past. He cited the Bihar government's earlier request, which was made way back in 2012, which considered by an interministerial group. The junior minister said the IMG had then come to the finding that based on the criteria prevailing at that time, the case for special category status for Bihar was not made out. Currently, no additional states are being granted special category status as the Constitution of India does not provide for such categorization. But will there be assistance given to Bihar like Andhra Pradesh is seeking? That's the big question. Now, the union budget is likely to be a continuation of the February vote on account. The government is likely to opt for fiscal prudence along with welfare measures. Importantly, expenditure, tax revenue, borrowings, interest payments and government capex targets are unlikely to see any big changes. So signalling continuity is what we are given to understand will be the thrust of the budget. Well, here's the latest controversy surrounding the NEET entrance exam. The Supreme Court has observed that there is evidence to suggest the widespread leak of question papers. The Apex Court has asked IIT Delhi to constitute a panel of 3 experts to review a contentious question and submit its findings by noon tomorrow. The court has also pulled up the National Testing Agency for distributing wrong question papers to students. This comes as opposition parties sparred with the government over irregularities after Parliament reconvened today. And sticking with the day's court action, the Supreme Court has stayed the UP government's order directing eateries on the Kanwar Yatra route to display owner details. The interim stay will also apply to the Uttarakhand government's directive, which mandates similar disclosures. However, the court did clarify that eateries should disclose the kind of food it is being served. It will hear the matter again on the 26th of July. The big global story, US President Joe Biden has dropped out of the presidential race. He has endorsed Vice President Kamala Harris as the Democratic Party nominee. Biden, in a written statement, said his withdrawal was in the best interest of the party in the country. The move comes weeks after pressure was building on Biden to drop out over concerns on his fitness. A flurry of Democrats, including the Clintons and top donors, have endorsed Kamala Harris. The Harris campaign has managed to raise $50 million in just 24 hours. Iman Haves gets us more.
Kamala Harris, you'd have to say at this point, absolutely the front runner, but has not clinched the Democratic nomination. That process will be official, we're told, and will start.
Iman, many thanks for joining us. Well, we will slip into a break, but when we return, the big budget exclusive. Tune in to CNBC-TV18, 9 a.m. on Budget Day tomorrow. We will be live from the National Stock Exchange with Morgan Stanley's Ridham Desai, Nilesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSE MD and CEO Ashish Chauhan. We ring the budget bell from the National Stock Exchange. And coming up next, a special conversation with the Chief Economic Advisor, Anant Nageshwaran, on the economic survey, the second that he's presenting. Stay tuned. Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for. Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
Well, the Prime Minister certainly talked about the budget delivering on growth, but the big question on everyone's mind, will a 240-seat mandate reframe the priorities of the union budget? Will there be more sweeteners for the middle class? Will there be more put on the table for welfare schemes? How will the government boost consumption? Those will be some of the key things to watch out for. Well, you should watch the budget on CNBC-TV18 because we have 25 years of experience decoding the fine print of the budget in real time. We understand the budget and we'll help you understand the budget as well.
Budget 2024. Go for growth.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21. Mr. Nageshwaran, many thanks for joining us here on CNBC-TV18 and congratulations on your second economic survey. There's a lot to unpack in the survey, but let's address the growth number there because while you have called it prudent, many on the street believe it is conservative. You've also articulated the reasons why you've kept the number between 6.5% to 7%. You believe that on account of the patchy monsoons, rising financial global market risks, as well as geopolitical uncertainty, all of this is going to weigh on growth. But is that the reason, or is there an overall recalibration as far as our growth aspiration is concerned?
Thank you, Shadin. First of all, there is no need to read much more than what I said in the presentation, which is that we, in February, when we wrote the Indian economy review, we were much more confident of the 7% number for FY25 because at the time the monsoon was still not on and geopolitical conflicts, we didn't think that they would continue or even escalate further. And financial markets have continued with their rise and naturally, therefore, now what we are seeing is maybe some signs of rising global political uncertainties and financial markets beginning to react as well to that. And the monsoon being patchy, as you mentioned. So this is just our recognition of the near-term factors, incremental factors at the margin that have become somewhat unfavorable. But we believe that if we persist with the kind of reforms that we have illustrated in the survey at all levels of government and with the private sector pitches in with its capital formation and employment generation, etc., achieving a sustained 7% growth rate in the coming years is possible.
You know, let's address that sustained 7% plus growth rate aspiration that you talked about, because you also said that the glue to sustaining growth lies in the nuts and bolts of deregulation, which you've also called the low-hanging fruit, Chief Economic Advisor. And you said it requires the grunt work to grow from the $10,000 per capita to the to $2,500 per capita to the $10,000 per capita. It will require an entirely different playbook. But how confident do you feel that we do have the nuts and bolts in place at this point in time, or it's work in progress to be able to make that big leap from 2,500 to 10,000? Have we changed the playbook enough?
No, I think that's a good question. But, you know, while it may not be possible for us to answer whether we have what it takes, that is where we have to look at where we were and where we have come. And I presented the information about the fact that our per capita income in dollar terms was 348 barely about 30 years ago, and we are at 2,500. That's a growth rate of about close to 7 times. So we have done that. And therefore, there is no reason to be pessimistic about the fact that we could rise to the occasion in terms of, and many states have done several reforms in areas where other states may have lagged. So I think the important thing is to induce a sense of competition among states. That is where the finance minister and the honorable prime minister repeatedly talk about the importance of tapping into both competitive and cooperative federalism. Those have to be put into action. Then it is possible that this deregulation agenda can kick off in all the states.
And that is a separate issue for another debate. But let me address the issue of private sector investment and private capex. And, while you do point out in the survey that signs are encouraging of private investment picking up, the demand from industry continues to be that the government will need to do the heavy lifting when it comes to capex. In fact, industry is demanding that the government improve on or better on the number that was presented in the interim budget. Do you believe that that is a legitimate ask, that case is warranted? Industries ask that the government continues to do the heavy lifting when it comes to capex.
The government has done the heavy lifting in 2 areas very, very substantially. One is with its own public investment, 2, getting the banking system balance sheet right and the banking system capitalized. And in fact, I would go to number 3, which is that the government cut the corporate taxes in September 2019. And the proof of the pudding is in the fact that I mentioned in the presentation as well, on a sample of over 30,000 companies, profit before tax in FY20 was 5.3 trillion or 5.3 lakh crore rupees. And FY23, it had risen to 20.6, which is almost 4 times. So the private sector has had an excellent run, which is good for them, and they have great balance sheets now. So now it is time for them to come good, or not for the sake of the economy, not for the sake of the government, but for their own sake. Because without employment generation, income growth, there will not be demand visibility, which is what they need as well. So that's why I said in the medium term, it's a win-win for them to follow through on the excellent profitability growth that we are seeing in the corporate sector.
I know, CA, that you're calling for indicted self-interest on the part of the corporate sector. And you said that the corporate sector hasn't had it as good as it currently does. But you also point out in the survey yourself that hiring and compensation growth haven't kept pace. So what gives you the confidence that this enlightened self-interest will start to kick off and we will in fact see the kind of growth that you expect both on hiring, compensation, as well as private investment?
I think, Shireen, you are actually contradicting yourself. In the earlier question, you were asking me about my growth being conservative, and you are asking me why am I being optimistic about private sector's enlightened self-interest prevailing. So I am optimistic, as I said.
I'm only asking you on the back of what the survey itself says, that while corporate profitability has quadrupled in the last 3 years, the same cannot be said as far as hiring trends or compensation is concerned.
They may have the reasons for reasons of COVID and the demand uncertainties coming from external shocks, but they have to understand that India is a large domestic economy and some of the demand generation is endogenous. I think we have to close here because, we have a series of interviews coming, Shireen, with other people, so we have to come back.
May I request one final question, CA, and that has to do with jobs, because that is something that you spend a lot of your time talking about in the survey. You talk about the fact that India needs to generate 78.5 lakh jobs annually by 2036. Now, again, I go back to the ask from industry: more PLI for labor-intensive sectors, more employment-linked incentives across sectors. Do you believe that that is a legitimate ask on the part of industry, and how do we get to this 8 million number that you spoke of in terms of jobs?
Look, in a large country, it's always possible for everybody to have asks and to invoke the famous lines from some American presidents. It's always important to talk in terms of asks and gives as well.
which is what the survey points out.
We look forward to speaking with you again tomorrow as the budget is presented, but appreciate you joining us this evening on CNBC TV18. Many thanks for your time. That is the Chief Economic Advisor, Anantha Nageshwaran, on CNBC TV18. We are going to take a break and return with more. Don't go anywhere. We're back in a moment.